You are listening to the FinancialSurvivalNetwork.com. I'm Kerry Lutz on 1230 WBZT. Well, looks like they're not going to taper, which means that the bubbles go on, which means that you got to figure out a way to keep your head above water. You got to measure risk. That's why Jason Hartman, JasonHartman.com, is with us to talk about the Hartman Risk Evaluator for using in investing in real estate. Jason, welcome back.
Hey, Kerry, thank you. You know, there's a lot of talk about bubbles today, and I think rightfully so. So I thought I would talk about how to dramatically reduce risk when investing. And so I'm looking forward to getting into that with you today.
Yeah, and you've got a whole method that you've developed over your many years of real estate investing that really cuts down on it dramatically, don't you?
It really does. And, you know, it took me 19 years to discover this, and it really was more of a discovery than a development. But I guess after the discovery, which I'll talk about that light bulb moment that happened to me several years ago, after the discovery, then I kind of put it, you know, down on paper into, you know, practical thought and application, and turned it into a real technique that investors can very easily use. And I mean, you know, it can't necessarily determine your upside, although it's probably a decent indicator of that too, but it can dramatically reduce any downside risk, almost eliminate it. Not eliminate it completely, but come very close to really mitigating any downside risk.
Yeah, well, there's always risk in everything, no matter what you do. So what you're always trying to do is to minimize it and to manage it, right?
Mm-hmm. Yeah, absolutely. Risk is something that, you know, we have to live with it if we're going to step outside of our home, if we're going to put our money in certain places, even if it's in the bank, or maybe especially in the bank.
Yeah, nowadays, you know, right?
Nowadays, yeah. You know, there's a lot of talk about bank holidays coming, and Cyprus-like confiscation and capital controls, and not just that, but even if none of that stuff happens, you know, so we have FDI insurance for $250,000 per vested account. But Kerry, you know, they ensure that you'll get the nominal amount of that money back, but they can't tell you what the money will be worth when you finally get it. And that's the problem. The biggest risk, really, we all know, is doing nothing. And you know, that's kind of counterintuitive, because a lot of people, you know, I was listening to one of the great courses recently. I don't know if you've heard of those, but they're on Audible, and I know you and I both like Audible. I have some of my products on there too. And, you know, one of the professors was talking about the fight or flight response that we all have as people, and animals, of course, have it too. And it's a necessary response for survival. But there's also a freeze response, a fight, flight, or freeze, because sometimes getting away from predators, it's best to actually do nothing and just freeze. That is definitely not true when it comes to our money, because doing nothing, we know that the insidious hidden tax known as inflation will destroy our wealth for sure. And, you know, in addition, of course, we have real taxes on any income that principal produces, and Obama years ago proposed an asset tax. So, you know, the government is broke. The government is looking for places to increase its revenue. So who knows if an asset tax won't be in our future, where literally you will just be taxed because you have something.
Yeah, well, the IMF just recently proposed one, right, Jason?
You know, I don't know about that. Tell me more.
Yeah, they came up with the concept of a wealth tax, and basically it was, you know, you got a certain amount of wealth, give some of it over to us because we need it. You know, we're the government, and we need it to keep things going, and that's how desperate things are getting.
Things are getting definitely desperate, but who is the IMF saying that to? To certain countries with money, or
basically, they're saying that the members are going to have to start seriously considering it because they're running out of possibilities for taxes. You know, and,
how did we ever get ourselves into this mess? How did we ever get ourselves in a situation where Michelle Obama's classmate and friend gets the no-bid government contract for a $400 million joke of a website that doesn't work for Obamacare. Yet 3 20-year-olds in San Francisco in a weekend develop a better site that's been load tested and actually
Yeah.
works. And they offered to give it to the government for free. They said we don't want any money, and the government said no, we don't want it.
Yeah. Yeah. That was healthsherpa.com. And
Unbelievable.
I tested it out. It's not exactly right, but it's certainly better than what the government is trying to force down your throat. That's for sure.
Yeah, yeah. It's we're in a crazy place, and people really need to be diligent about paying attention, about taking action, taking steps to protect and preserve their wealth. And that's one of the things I love about your show is, you've got all these different guests that talk about that stuff. And, I come at it from the income property angle. That's my favorite solution is to own assets, to own commodities that have universal need that you can finance with long-term fixed rate debt and then outsource that debt to another party called a tenant. I mean, we don't pay our own debts as real estate investors. We have other people pay them for us.
Mm-hmm. Exactly. That's the beauty of it. And basically, you're a beneficiary of inflation when you're a owner of real estate and it's leveraged, right?
Absolutely, because inflation basically, in quotes, pays down that debt for you. I mean, think about it. If you just have a relatively low inflation rate, in real terms, not in the official statistics that are, of course, manipulated and bogus. You probably had John Williams on your show. I had him on my show before. He's the guy behind shadowstats.com. And, in the inflation numbers are manipulated. The unemployment numbers are manipulated, of course. Everything is manipulated. We can just count on that. So, I don't know if I think this anymore, but certainly a year ago, I thought that the real rate of inflation was about 9 to 10%. I do think it's a little bit lower than that now. And the government was telling us it's around 2% at the very same time. So, of course, that's completely bogus. But, think about it. If you have $1 million in debt against income properties, against income producing real estate, those are all made of commodities, those sticks and bricks. So what is an apartment building made of? What is a house made of? Well, glass, steel, concrete, copper wire, petroleum products, energy. All of these things are things that we as investors believe have universal demand, and they do, and are very likely to go up in price, at least in nominal dollars, if not real dollars. So that's one way we hedge inflation, is just by owning commodities. But then the second way we do it, and this is unique to income property, is that we have 30-year long-term fixed rate debt against those commodities. I call them packaged commodities because they're packaged in the form of a house or an apartment building. And that debt, we're borrowing that money at a rate below the rate of real inflation. So that's the first thing. But then it even gets better, Kerry. We go and we say to the tenant, look, I want to outsource my debt to you. You pay all my expenses of owning this property. So you basically get the property for free. and then if you have 10% inflation, just for round numbers, on a $1 million mortgage or group of 10 mortgages, doesn't matter which way you do it, $100,000 a year is getting paid off by inflation. Because in real dollars, 1 year later, you owe $100,000 less. This is the secret of wealthy investors. This is how, the big kids win the game through inflation. And this is why inflation is really, in terms of government and all the, dysfunction of government, inflation is really an awesome strategy for government. I'm not saying I approve. I'm just saying, given the circumstances of spendthrift governments that pander to buy votes, it's terrible what they do, but the fact is they do it, and it's not going to stop anytime soon. It happens all around the world, and it's not unique to the U.S., and governments will inflate their way out of their problems, and it really benefits us. So what we're doing is we're saying, let's do the same thing they do. let's do the same thing, probably all the investments that Greenspan has and Bernanke has and Janet Yellen has, our Federal Reserve chairs, and even good old Paul Volcker, who was the only legitimate guy.
Yeah.
They probably invest this exact same way. We know the government does it. We know how the government operates. And what we want to say is operate the same way, in essence.
Hey, Will Rogers said it best: invest in inflation. It's the only thing going up.
Yep. Very good point.
Right.
Very good point. Hey, so do you want to dive into this risk evaluator thing?
Yeah, let's do that. But first, we've got a special offer for you out there. If you're listening now, this is a great deal, because I don't know if you've ever seen Jason address a crowd, address a group, but I have at the Equity University, and really it was captivating. Jason, you were an amazing speaker, and you're not some academic who's reading from a book or whatever. You're a guy who's actually been out there doing this for a lot of years. And, for somebody, if you're looking to get into real estate and you can learn from a master like Jason, it's really worth it. And you've got a live course that you're going to be teaching later on in January of 2014, and you can win a seat at that course. Jason's graciously going to be giving out 2 seats to the live course. So tell us about that, Jason.
Right. So this is our once-a-year event. It's called Meet the Masters of Income Property Investing. Meet the Masters of Income Property Investing. And this one, we do it every year. This one's at the Hyatt Regency in Irvine. We've got a beautiful conference center with the big leather seats, and everybody's got a desk. This is not one of these pitch fest things. We actually charge real money for it. The ticket cost right now, as I speak, is $600 per ticket. And we've got about half of the room sold already. It caps out at 100 people. And people fly in from, all over the country and sometimes all over the world for this. We've got a couple coming from Japan to this event. And we've had people come from Europe in the past, and all over the U.S., East Coast, Canada, etc. Canada's not in the U.S. I understand that, but you know what I mean.
Close enough.
North America, close enough for government work, right? And so this is a full day. Saturday we go from 9 to 9, 12-hour day. Okay, and it's at a beautiful hotel, the Hyatt Regency Irvine, and then Sunday we go 9 to 6. And so we have a bunch of great speakers that come in and talk about tax strategies for investors, asset protection strategies. We have some of our different providers with properties, and our different property managers come in. They fly in from all over the country to talk about their offerings and their different properties. And then we have people that talk about the economy. Last year, we were going to have G. Edward Griffin speak. And then we were thinking about doing that again. We're still kind of thinking about that. But he had a conflict last year, so we were thinking about getting him to come this time. But, we have economists, we have advisors, we have people that talk about where their specialty is investing with your IRA, whether you want to buy real estate or gold or whatever. Just a whole bunch of great subjects. We talk about loan modifications and, credit enhancement, how to get your FICO score way up there. It's just a wealth of information from a bunch of different speakers. I do the opening keynote, and then I MC the whole event throughout the weekend. And, it'll be a great time. It always is. It sells out every time we do it. And it's only once a year. So this is Hyatt Regency, Irvine, California. That's Southern California, just south of Los Angeles. And we've got a special room block rate, very low prices. You don't even need to rent a car. The airport's right next to it. So it's super easy, and it's just a great weekend. So we're going to give away 2 free tickets for that. Those are $600 each, and that's the real price that we actually sell them for today. It's not a bunch of hype where we just valued at, I know how these promoters work. I've heard all the pitches.
Yeah, you know that.
And then we're going to give away 5 more for those of you who either can't come to the event or you didn't get the first 2 that want to actually attend live. We're going to give away 5 more of the home study courses that includes a 500-page workbook. it's basically all the PowerPoint slides of all the speakers. And I think it's got 22 hours of audio content. And that's all a digital download. You can put it on your Kindle, your iPod, your iPhone, whatever, your Android phone. And it's just great. So, if you can't come to the live event or don't win the tickets to the live event, you can win the home study course. And that is currently selling at $497, so $500 for the home study course.
Yeah,
so there we go.
Deal. And and basically the link is Jason Hartman, HARTMAN.com/Lutz, LUTZ, JasonHartman.com/Lutz. Go there, sign up for the contest. So it's 2 tickets being given away, $600 value each, and 5 of these courses at $497 each, and they're well worth their value, even if you have to pay for them, for sure.
Right. Yeah, and a lot of people do pay for them. Yeah, absolutely. So, we just do some special promos on your show, and Kerry, you're always good about twisting my arm to, to make very generous offers. So you're really good about it for your listeners.
Yeah, well, it's a real value, and it's something that we like you to check out because look, there's not a lot of choices there to really profit from and protect yourself from what's coming down the pike here. And what's coming down the pike, Jason, you know it, and I know it, is really very obvious. I mean, it's just totally clear what's going to happen here.
Let's not all be in the position, of 5 years from now looking back and saying I could have, I should have, I would have. We all knew this was coming. We know this is coming. We know that we're in massive debt. We know that the government is broke. We know that this whole thing is a house of cards. This whole economy is built on smoke and mirrors. And it's not just the U.S. economy, it's the global economy. So we've got to plan and act. Okay, so let's talk about reducing risk. Okay.
Yeah, let's talk about the
Kerry,
Hartman.
The Hartman Risk Evaluator. Okay, so let me tell you what happened to me. It's really amazing because I got a call. I was 19 years in the real estate business at this point, and I had purchased my first out-of-state property. Before then, I had always invested for 19 years, basically in Southern California properties, and I just didn't want to go through another big downturn again. I knew it was coming. I predicted very correctly that the end of the good market would be at the end of 2005. Okay. And coincidentally, I will tell you, I sold my real estate company to Coldwell Banker right at the end of 2005.
Perfect timing.
They all have told me I had great timing there. And I knew that because the adjustable rate mortgages were going to adjust. Okay. And people were so over leveraged. They were just in a mess. I just knew the whole thing was coming to a screeching halt, and I was correct. And one of the things that happened is I thought, I still love real estate. I still love income property. And it's the old thing that all real estate is local. So I wanted to just diversify and invest around the country in different markets that would potentially be counter-cyclical to the California market and all the properties I had there. So I started lightening my load in California and increasing my load in some of the other cities and states that I thought had better prospects than California, and coincidentally still do almost 9 years later. Well, this property that I purchased was just a little single family home, and I purchased it for $159,900. Okay, just $160,000. No big deal, just a little house. And, being a Southern California investor buying properties in Irvine, Newport Coast, before that, I thought, gosh, this is so cheap, I'll just buy 10 of them. It's really
They're
funny.
On sale.
When you take your California brain in these other markets, you got to be careful of that, okay? But anyway, so I bought this property for $160,000, basically. And my insurance agent, Jennifer, called me up and said, okay, we're going to give you, I was about to close the deal, and she said, we're going to give you $135,000 of insurance on the property. And I understood, Kerry, that they only insure the structure, not the land, because the land will always be there. The land doesn't burn down. Okay, the land doesn't get vandalized or flooded. It gets flooded, but not in any way that it doesn't recover from.
Not permanently.
Okay? Yeah, exactly. And so, the land will always be there. So when you get homeowners insurance, You only insure the structure, the house sitting on the land. And I thought, well, the insurance company believes that the land is worth 130, or that the structure is worth $135,000. So let me just reverse out of that. That means the land is worth $24,900, right? Just doing the math, okay? Mm-hmm. And what I realized is that this is a really good way to protect yourself from downside risk, because if you look at the actual replacement cost of the building, the value of the structure as a limit to how much depreciation a property could have, you're in pretty good shape. Now, certainly in very bad times, properties do sell below the cost of construction, and heck, we've had a lot of investors, including myself, a lot of our clients, though, gobble up properties well below the cost of construction. And you can still do it occasionally now, but not nearly as much, at least not in good, desirable markets, as much as you could, a year and a half, 2 years ago, because things have obviously changed. Well, so that puts some sort of a floor on your downside risk, okay? Because to replace it or rebuild it, a builder has to spend that much. I mean, the value of that structure includes the improvement value of that property is the cost to build it plus the builder's profit. So if you look at it that way, if properties are selling below the cost of construction, well, builders aren't going to build, right? What just happened the last 5 years during the financial crisis? Builders stopped building. The construction machine came to a screeching halt. I mean, there was almost nothing being built in terms of new housing inventory. And as that supply was gobbled up and prices started to rise, and developers realized they could make the very simple equation work, cost to build plus builder's profit, then they started building again. Imagine that. So this really, understanding construction cost, understanding that whenever you buy a property, you really aren't buying one thing, you're buying two things. There are two components. There's the land value, and then there's the improvement or the structure value sitting on the land. Okay? Now, this is interesting too. What influences the value of the improvement sitting on the land? Well, one thing that influences is environmentalism. Okay, so in places like Austin, Texas, where you have a fairly strong environmental movement, and you have some degree of building restrictions, that influences the prices of improved land. And there's an old riddle about that you'll probably love. You probably heard it, Kerry. It's what do you call a developer? Someone who wants to build a house in the woods or at the beach. And then the second part is, what do you call an environmentalist? Somebody who already has a house in the woods or at the beach. And so that's the way that works. We know that equation, that not in my backyard.
And then NIMBYs, yep.
The NIMBYs, exactly. And the other part of this construction cost and improved land value is the industrialization of developing countries. So you look at China, you look at India, and they're driving up the cost of raw materials. Anytime there's a natural disaster, like the tragedy that just happened in the Philippines, like New Orleans with Katrina years ago, any of these catastrophes, Fukushima in Japan, it causes a big demand for construction materials. These raw materials are needed to rebuild. Well, I'll give you an example. In 2004, the government told us that inflation, the official rate of inflation, was only 3.3%. Yet during that very same year, steel and iron prices surged by 34%, more than 10 times the official rate of inflation. And during that same time, lumber was up nearly 17%. The prices of gypsum or wallboard were up 20%. So, you see how that works. This sets a real downside floor on any risk that you might encounter. And then, of course, labor and energy costs go into this equation in a big way as well. So that's the basic philosophy, and I can get into some more specifics, but I don't know how we're doing on time.
Oh, we're good. We're
good.
Can,
okay.
Yeah, let's talk about some more about it, because it's,
okay.
What I like about it, Jason, is that a lot of people talk about real estate. You can turn on HG Network, you can turn on any station after 10 o'clock in the night, and you'll see 25 people on there. But you have such an interesting perspective about it. And I know you personally. I know that you don't just talk the talk, you walk the walk. You've been doing this for a couple of decades now, and people look up to you and they know that when you say something, it's not something that came out of a textbook. It's not out of a financial calculator. It's something that you've actually proven through experience. And that's really the great part about it. So,
Yeah.
So
Yeah, absolutely.
that's really what it's about.
The most expensive schooling you'll ever get is actual experience.
Yeah. Yep. The school of hard knocks, and it's alive and well.
Yeah, it is. But I don't know. It may be cheaper than these overpriced colleges are nowadays. I tell you, if you're listening and you have kids that are approaching college age, really consider whether that's worth it. I'm not sure it is anymore. The world has changed so much. Credentials are sort of so much less valuable than they used to be.
It depends. It depends.
Yeah, it depends. I don't ever want to say don't become educated. Of course, education is vitally important, but I don't know, with college tuition going up at 3 and 4 times the rate of inflation, these universities just becoming big marketing machines, and student loan debt that's not dischargeable in bankruptcy, so no one ever gets a second chance. It's just indentured servitude.
Jim Rogers, in his new book, about the street, I can't remember the exact title, but I talked to him about it. He discusses this very topic, and unless you're going for a STEM course, I think that learning additional languages, I'm discovering, because my son is fluent in Spanish and German, so that gives you a certain marketability to international corporations that you wouldn't otherwise have, and some other basic skills with that. But otherwise, maybe you're better off. Hey, there's a show, and I've been meaning to do a commentary on it, and after I'm done with you, I'm going to, called Gold Rush. So the kid, his name is Parker Schnabel. I don't know where the heck he lives, and I don't know what kind of name Schnabel is, but the parents and the grandparents are gold miners, and he had his choice. You can go gold mining or you can go to college. So they give him his college fund, which is 100 ounces of gold, which is, at the time, is worth $160,000, and they give him a jar of gold dust, Jason, and they say, "Go ye forth and mine." And he's 18 years old, and he's waking up at the crack of dawn, and he's in a excavator, and he's digging up dirt, and he's making a lot of mistakes because he's a kid. Let's face it, but you got to admire this kid's work ethic, and he's trying to find wealth in the ground. So, that is something that you look at that kid and you say, my God, he's something. He's like an old-fashioned American, and he's out there in the Klondike, where it's god-awful cold, and he's got a wash plant, and he's digging up tons and tons of dirt, and he's trying to find gold.
Yeah,
it's just remarkable.
That's really interesting that you bring that up, Kerry, because I know you've had Jim Rogers on your show. I've had him on mine show 2 times now, and he's great. I love Jim Rogers, and I love the fact that he's really into real things like commodities. And you and I are both in agreement there, even though we approach it differently. I like the real estate commodity because I look at the ingredients of every house or apartment building I buy and my clients buy. It's sticks and bricks. It's stuff that's needed around the world. It has a universal need. But Jim Rogers says something also very interesting like that. He says, you see all these people going to college, and their parents or they are plunking down, $200,000 for a nearly useless liberal arts degree. Yet at the same time, how many people do you see nowadays becoming a farmer?
Exactly.
Food is a real thing that people actually need. I don't know how many. How are we doing getting people with English literature master's degrees hired? What job do they do again, except teach in a brainwashing liberal university?
They could probably become Obamacare navigators. They'd probably be well situated to do that. But short of that, I don't know what they can do. and it's a little distressing. But I like your concept, and you've really brought me around on the real estate thing, because collapse is coming, don't know when. You're better off owning something real than not real when it does come. And the fact is, when you look at a house as really an assortment of commodities, it takes on a whole different meaning, especially if you're using it to generate income.
Yeah, right. Exactly. And we've got to always remember that real estate is a multi-dimensional asset class, and that's the thing. It has so many components to it that create income. They call real estate the ideal investment because it has income, depreciation, equity buildup, appreciation, and leverage. And of course we didn't even mention other benefits as well, but those are, it makes a nice acronym: ideal: income, depreciation, equity buildup, appreciation, and leverage. So real estate is great like that. It really is. So let's dive back into this risk evaluator, and let me tell you a little more of my story here. Okay. So I bought this property in Irvine, California. And that's where that was the last property I bought in Southern California before moving to Arizona and before deciding that California is not the place to invest. Okay, but this was about 2004, and the property was $815,000. You can look the property up. It's 35 Arborside in Irvine, California, and I owned this property for about 7 years, I think, and I paid $815,000. And I remember my girlfriend at the time, Monique, trying to talk me out of buying it. She thought it was overpriced and a bad deal, and I just went ahead anyway. I kind of didn't know any better, so maybe I got lucky, maybe I was good. I'm not sure, but it's better to be lucky than good any day of the week. Now, here's what's interesting, though. Okay, this is why I tell you this. $815,000 property. I got my first tax bill from John Morlock, the Orange County tax assessor in Orange County, California.
Not your favorite person, to say the least.
Well, yeah. I mean, the taxes are outrageous. They're like $11,000 a year. It's nuts. They're crazy. But anyway, what they do on the tax bill is they divide up the value of the land versus the value of the improvement or the building or the house sitting on the land, which we were talking about earlier. And here's where it gets important. So here's the way it divided up. I'm rounding off here, but basically $659,000 in land value and $156,000 in improvement value. So $815,000 total value. Now, why is that important? Well, let's compare it to the house I mentioned where Jennifer, my insurance agent, called me and said, on the house you just paid $159,000 for, we're going to give you $135,000 worth of insurance. Okay? There are 3 places you can go to find out the value of the 2 components of an income property that you own. So what are the 2 components again? One value is the land value. The other is the improvement, the house or the apartment building sitting on the land. Okay, that's the improvement value. So 3 places you can go. You can get an idea of that from your county tax assessor, because they divide it up. You can get an idea from your insurance agent, or you can have an appraisal. Those are basically 3 ways you can find out. Well, let's look at the comparison. So I had $135,000 in improvement value on the house in Georgia, and the whole price was $159,000. Yet the house in Irvine, California, I had $156,000 in land and improvement value. So not much more of it was improvement. I mean, it wasn't much more expensive than the house in Georgia, right? Mm-hmm. But the land value was dramatically different. In Irvine, California, the land value was $660,000, or 81% of the equation of the 815. Yet in Georgia, the land value was only $24,000. Okay, Now, here's what happened. I told you I'd rather be lucky than good any day of the week, right? Well, a year later, I noticed all the houses in my neighborhood where I was living in Irvine appreciating. pretty dramatically. It was bubble city, okay? The bubble was in full swing then, okay? It was like crazy. It was nuts, okay? And speculators love that type of thing, but not prudent investors. It's not how prudent investors invest. Prudent people invest for income and cash flow. Gamblers, they speculate, and sometimes they win, mostly they lose, I say, over time. So that property, I thought, gosh, I want to pull some equity out and refinance and buy some more properties in other states because I'm just loving the cash flow on these little properties. And so the appraiser comes over and he says, hey, congratulations, Mr. Hartman. Your house is now worth $1.3 million. And I thought, only a year went by.
Lucky you.
Well, yeah, definitely not good, just lucky. Only a year went by, and I had a capital gain there of $485,000. Do I love real estate or what? Okay. But guess what? A year later than that, I called them again, and I had one of my two loans was adjustable, and I don't do adjustable loans. I don't like adjustable loans, but at the time it seemed okay. Well, I wanted to refinance that to a fixed rate loan because rates were very low. So a year later, I call the same bank back, and they send out the exact same appraiser. His name was Eric. And he actually came to one of my seminars in Newport Beach where I was talking about this very concept, and he sat right in the front row over to the left side of me as I was explaining it. And the whole example was generated by him and the insurance agent, Jennifer. Okay. So a year later, I refinance again, and he says, hey, I'm sorry to tell you this year that your property has actually gone down in value. It's now worth $1,215,000. So I'm only up $400,000, still pretty great, but I'm down $85,000 from the peak. Okay. But the question here, Kerry, is when you go from $815,000 to $1.3 million, what went up? Did the land go up or did the improvement go up of the house? Remember, we got to think in two components as smart investors. When we want to reduce risk, that's how we have to think. Two components, not one. So what went up, the land or the structure sitting on the land? What do you think?
Oh, it was the land that went up for sure, right?
Yeah, you're absolutely right. I mean, look, what's better, a used house or a new house? Well, new house is better than a used one usually, right?
Yeah, sure.
So it's all in the land value. And then a year later, when it went down by $85,000, it didn't become $85,000 cheaper to build a $156,000 house. Okay? It all came out of the land.
Right.
So we know that the risk area, here is the lesson. The risk area is in high land value markets. Those are the very cyclical boom and bust bubble markets. They're California, they're New York, they're Miami. Okay, they're the Chicago city area that's expensive. Some of the outlying areas of Chicago aren't expensive, but any area that is expensive around the globe. This is a global rule. Okay, it doesn't just work in the U.S. It works anywhere around the planet. High land value markets are the most risky markets, and even to add insult to injury, it becomes worse because they always have terrible cash flow. Okay?
Sure.
We want to get cash flow of about 1% of the value of the property. You can never come anywhere close to that in high land value markets. Okay? So what we want to do as investors is we want to stay away from high land values and we want to go toward low land values. Just to conclude this example, if my land value on this property is $1.1 million at the peak of the market, and it goes to half, how much do I lose? $550,000, right?
Right.
Okay. My little house in Georgia, if my land value goes down by half, how much do I lose there? $12,000.
Yeah.
I can handle a $12,000 loss. $550,000, that's going to hurt, Kerry.
Oh, yeah, that's going to hurt big time. So sum up the moral of the story of the Hartman Risk Evaluator and why it's made you so much money and why it can make you so much money.
summing it up is understand the two components of any property, the land component and the improvement or the structure component. And those values are different. And you've got to be buying at or very close to the cost of construction or replacement. If you're paying anywhere over $120 per square foot for any property, you're probably paying for land. What I didn't tell you, that $1.3 million property in Irvine, California at the peak, it was only 1,800 square feet.
Really? Wow.
I mean, the cost
That's
per
amazing.
square foot is like, what, $800 or something?
Incredible.
It's absurd. Okay, you got to be buying properties ideally for $80 a square foot.
Yeah.
You know, we have even properties for less than that are still amazingly below the cost of construction. But do not, the land should be very cheap or free in the equation. That's the way you will have better cash flow and much lower downside risk, because the construction cost or the replacement cost sets a floor on the downside risk.
That makes total sense. So anyway, we got to go now, but don't forget, go over to jasonhartman.com/Lutz, sign up for the contest, win one of those two $600 seats, or the backup prize is $500 course, $497 course for Jason's great course, because, you just can't. This just isn't available. They don't teach it in college. They don't teach it in high school. It's only available from Jason, jasonhartman.com/Lutz. We'll talk with you again real soon, Jason. You be well.
All right. Hey, thanks so much, Kerry.
Always a pleasure.